In this week's update, there is a strong and logical economic case for markets to fall, why most people struggle with the market, and how to prepare for the inevitable bargains. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. It's been a massive week with the Fed raising interest rates another 0.75%, and in particular the rhetoric that went with that and the projections about how far interest rates would go. And to be honest, that has caught Wall Street off guard. Wall Street wasn't expecting, I don't think, what has occurred during the week, and as a result, there was a very significant sell-off on Thursday and Friday. Now, I just want to start with some really important market reality because the media is now going to tell you that the sky's falling in, and so now is a time that can be very dangerous, or it can be a time of great opportunity, depending on how you respond. So having a sharp perspective on what's going on, which is why I do these weekend videos and have been for years and years and years, is to help people get a clear perspective of what's really going on. That's completely independent from the media that just is trying to grab your attention. So it's absolutely normal for us to rely on economic fundamentals or logic to predict a certain outcome. I mean, that would be how we would normally respond. But if you do it that way, it just happens to be quite ineffective. And I talk about this in one form or another almost every single week. It just doesn't work out that way because the economic fundamentals and the logic is really being applied to the immediate present past, which we have a strong bias towards, or it relates to what's happening today. It's not relating to what's happening or what is likely to happen in 6 to 9 months' time. And that is what the market is pricing in. It's the future. It's not today, and it's not the last 3 months. So that's why it's very ineffective to move forward on that basis. Now, it's not to say that you just completely ignore economic fundamentals, but you certainly need to, in my opinion, overweight what the charts are telling you, what the price action is telling you. So this is a really difficult concept for many. It's not easy. It's why the market is so difficult. But I've been doing this now for 35 years, and 35 years of observation that says that it's true. If that's where you want to pin your hat, just purely on what makes fundamental logical sense, then you're always going to struggle in the market. And I'm sorry, but that's just the reality. The important thing is to focus on where the money's flowing. What is Wall Street actually doing? And if you can make that shift to overemphasizing what the money flows are telling you, then your results are going to be far better. So what has changed? Let's have a look back over the last year or two to see what has changed. We've moved from a deflationary environment for nearly 4 decades to an inflationary environment, and that has been accompanied by a 4-decade reversal in the long-term interest rates. We've moved from, particularly in the last 10 years, we've moved from extraordinary liquidity injection by all sorts of means, by lower rates, by quantitative easing, by a number of mechanisms, to we're now in a situation where central banks, because of inflation, are now having to withdraw liquidity. And so interest rates are going up. We're now in a period of what's called quantitative tightening, which means that the government is now not rolling over bonds and it's not buying new bonds. It's actually letting them expire, which is withdrawing liquidity from the system. Now, that has to have an impact on stock valuations at a big picture level. So this is a bit of this is the fundamental economic logic, and it has a degree of validity, but it shouldn't be your primary indicator of how you act in the next 30 days. So there will be an impact on stock valuations. PE ratios must adjust. And we've seen that in the last 2 or 3 days. The market's been caught unawares was expecting that the Fed wouldn't go as hard as it possibly now appears that it will. And that requires a readjustment down. The likelihood of a recession is now much higher than it was. That's going to crimp earnings, and you're going to get a double whammy effect here. So broad earnings per share growth is likely to decline. Now, these comments are made in respect to the whole market, the index, if you like. There will be sectors that will not be impacted. There will not be a slowdown in earnings in certain sectors. And so therefore, and in many cases, those stocks aren't expensive either. So there's not a case for those stock prices to fall either based on future reduced earnings or the requirement for the PE ratios to come down, because the PE ratios are already low. And we're seeing that particularly in some of the battery materials producers. So what we're going to see for the bulk of the market, and this is the danger for most people, is a double whammy impact on prices. So earnings forecasts are going to come down, so that's going to reduce prices. And then as a consequence of that, the PE ratios are going to contract. And so those two working in tandem have an outsized effect on stock prices. So I think it's safe to say that over the medium term, we are going to see a significant drop in many stock prices, but not all, and that's the key thing. Now, it's pretty obvious that after the best part of 3 decades where central banks prioritised preserving asset prices, stopping the housing market falling over, stopping the stock market falling over, that was more of a priority. And they were, just letting inflation or the future monetary consequences just be whatever they would be. And that's easy to do when interest rates are low and inflation is benign. It's really easy to do. But now the game has changed. And so central banks are now moving to tame inflation. They should have got ahead of the curve, probably 4 or 5 years ago, but they didn't. And so now we're going to get this significant prioritisation, and that they are going to run economies into recession if needed. That there would now appear to be that level of commitment from central banks that we haven't seen probably since the 80s. Now, that's all pretty sombre stuff. Sorry to mess up your Sunday with a lot of negative news, but anyone that's watched me for any period of time knows that I call it as I see it. I'm fundamentally bullish, but I don't stick my head under the blankets and ignore what's staring me in the face, and this is what is now staring us in the face. Is there anything on the positive side? Well, yes, there is. We've still got mega trends out there that are going to continue, and a global recession or slowing earnings in the majority of the market are not going to change that. And so some parts of the market are still going to be very exciting and very investable. So what could happen? Well, there's a couple of things here. Higher rates could do their job and do their job quickly, because the impact of higher rates hasn't really been felt yet, but is just starting to be. So the Fed's the indicator that the Fed looks at the most is the core PCE, which is personal consumer expenditure, and that is showing that it's topped out and is starting to roll over, and that's the main indicator they're looking at. So a couple more months' time, the impact on that PCE indicator could be sufficient for the Fed to back off sooner rather than later. So that's one possibility. So inflation falls quickly, and global markets, if that is the case, then global markets are going to rally very hard. Personally, right at the moment, I don't think that's what you want to be pinning your hopes on. The other alternative is that inflation remains elevated. the central banks are now facing a bigger struggle to get inflation under control than what they expected. We're going to have to go into a more significant recession to make the adjustment. And so that means that interest rates go higher and for longer. And in that case, it would be normal. This is not a prediction. Just observing what is normal in previous global recessionary periods and interest rate rising cycles. Global markets will, at the index level, will typically fall 40 to 50%. And that's typical of a recessionary period. Now, right now, the S&P is down 22%. So you could argue that, if this is going to be where the market ends up, then we're about halfway through at the index level. So the bottom line is that there is a major adjustment process underway, no question. We're going to end up with what's called a bifurcated market. In other words, we're going to have the bulk of the market is probably going to go lower, but some parts of the market are just going to continue on their merry way because they're not impacted by what's going on. So as I've been saying now forever that I can remember, you just want to focus on what's working, focus on where the money flows are going, and just forget about the rest of the market, forget about the index. If you're not trading the index, then who cares? Just go where the money flows are keeping positive sentiment. So it's what you own and how you own it, how you buy it, how you manage it, how you vary your overall exposure. All those things are important, and you can control all those things. We can't control what the index is going to do and how the market's going to respond to perceptions about central banks. So, don't worry about it. Just focus on what you can control, and there's many things that we can control. And such periods always unveil stunning opportunities, every time. So, that's the message that I would like everyone to take away from this particular video. So the question is, what will you do? Will you hide and succumb to the media and to your emotions because there's a lot of red on your screen and it just all seems too hard? Or will you be clear-headed and calculatingly bold because there are some great rewards waiting for those who can be calculatingly bold? So what else can we do? What are all the things that we can control? We can have a mechanism to gain conviction. You either do the research work yourself, but I give you fair warning, it takes a lot of consistent and very, very concerted work. Or you align yourself with someone that has the conviction and can give you that direction. 2, you retain an open mind. I talk about this nearly every week, and clearly from the comments there are some people still out there that don't have an open mind, but nevertheless, when markets are fast moving, it's really easy to get like the deer in the headlights a little bit. So keep an open mind, keep your head clear, filter out the noise, because if you let the noise of the media and your emotions get in the way, then you're just going to be whipsawing in and out of the market. You'll be making inappropriate moves at the wrong time, selling when you should be buying and buying when you should be selling. You need to understand risk versus reward fairly clearly, or again, align yourself with someone who does. And that comes in 2 forms. There are a number of things that you can do to reduce the fundamental risk. You can buy stocks where the earnings growth is almost assured, even if we do have a recession, even if interest rates go to 4.5% or 5%. And we can buy stocks where the current PE ratios are still very modest. So there are many things, there's a huge list here, but there are many things we can do to reduce the fundamental risks of the stocks that we buy and the stocks that we own. The next thing that you can do is on the technical side, and that's lower your entry risk by having a better ability to read stock charts and what they're telling you, what the money flows are telling you. The next thing would be, and I think this is going to be important at least in the next 3 to 6 months, is be more active and understand what your signals are to exit a position if you need to. Most people really struggle, and this is the feedback I've had now for a couple of decades. The one question that I get consistently asked is that people have trouble knowing when to take profit or to step aside from the market. That's the biggest question that I get. So you need to be clearer about what your signals are that will influence you to exit a position. And the final thing is, don't be the deer in the headlights. See volatility as an opportunity. See volatility as your friend. All right, let's have a look at the American market. So the scoreboard, ugly. The S&P fell 4.6% last week, 4.7% this week. But in the final hour, there was a really nice bounce off almost precisely the June lows, which is, it's all a bit technical. And maybe that's what the computer algorithms did. It pushed the market down to the June lows, and then everything reversed and we got a decent bounce. So a double bottom has been formed. The question is, will it hold? Given the severity of the selling in the last couple of days, I'm not confident that the support will hold. The market is now causing me to shift my position, which is fine. I'm completely relaxed about that. Just, observe and respond according to what the market is doing, not what you think it should do. Now, Q3 earnings, which are going to start fairly soon, are now become really vital, absolutely vital, because the market is been caught off guard. It's now readjusting downwards the earnings expectations and therefore the PE ratios and therefore the prices. But if for some reason Q3 came in a bit better than the market expected, then that would be a very positive thing. So Q3 earnings absolutely vital. The US dollar index shot up to 113, which is, you'll see from the charts, we haven't been up there for a very long period of time. So that's keeping pressure on other currencies, and it's also putting some pressure on commodity prices as well. Now the 10-year yield also broke out. We were at 3.48 was the previous high, but we've now burst through that, and 3.69 is where it finished. The VIX spiked over 30, so there's certainly a level of fear back in the market. Ended 29.9, just a touch under it as the market bounced in that final hour. The 10-year, 2-year spread continues to rise. It's now at negative 0.5, so the bond market is screaming the recession is coming. All right, let's take a look at the markets. This is the S&P. As you can see, we tagged the June lows almost to the unit, and then bounced. But what we've saw several times during the week was big gap down openings, and you don't see it so much on the S&P, but you certainly see it looking at a lot of individual stock charts. Lots of gaps, and a lot of the losses are really occurring in that opening gap. Now, I think this is what I had on the screen last week. So we'll ignore that because I've got other charts I want to look at. But the point I was making last week is that the bull case had been weakened as we stood last week, but it was not been killed, and it still hasn't been killed. There are a few positives out there on balance, but it's certainly on pretty shaky ground at the moment. If we look at the Nasdaq actually did slightly better. It hasn't quite made it down to the June lows, and we also got quite a nice bounce. But look, clearly this is a very negative chart. I'm not trying to sugarcoat this and say that it's that it's not a negative chart. The fact that we've come almost all the way back down to the June lows, once we broke through this 61.8% level, then the market was weak, and that occurred on the 15th September, so just about 10 days ago, and it's fallen away very, very quickly. So these June low support levels are pretty important, and if they break, you'll almost certainly see a fair degree of technical selling kick in. The computer algorithms will do that. Now, a chart that is really important, this is HYG, which is the junk bond, the ETF covering the junk bond section of the market. The spread between, and I wrote this a couple of days ago, and we've since had a big breakdown on Friday night. But what I wrote was the spread between the investment grade bonds and junk bonds remains far too tight. In other words, you're only getting a few percent better yield for being in really low quality bonds, and that's just not enough. That makes no sense. You should be getting somewhere between 5 and 7% additional yield to be in high risk bonds. And this all stems from what's happened over the last decade or more, where people have been desperate for yield, and so they've gone to more risky avenues. So fundamentally, the adjustment process should continue, and this is where we ended up in the COVID crash lows down here in the 68, and we closed on Friday night at 72. So we've still got a little bit of distance to go, but the important thing here is just respect the price action more than the logic. Again, really, really important. Just something that I mentioned before on understanding what your exit signals really look like. And I'm just using the chart of Pilgrim Mines here. This isn't anything other than a convenient chart to use. It's not a recommendation. But you can see here, this is a stock that has done just extraordinarily well, and it's miles above the 20-day moving average, and therefore vulnerable to profit taking, significant profit taking in this sort of market. Yet it hasn't. And I've got a couple of very clear signals that I look for to get out, and they haven't yet been triggered. And who knows, this could just keep marching on to $20 or $25. No idea. I know in the past, when I wasn't as clear in my mind about my profit-taking process, I got out of a lot of these stocks far too early, left far too much money on the table. So have a clear understanding about what your exit signals look like. And members of my services, get that information in spades. If you don't know what your exit signals look like, both for profit-taking or for minimising losses, then your decisions are going to be emotionally based. They're going to be inconsistent, and you are almost certainly going to get worse long-term outcomes. I can, promise you that. So the one thing that you want to work on, or find someone that can help you work on it, is understanding what your exit signals look like. All right, let's go and look at. I think let's look at some of the important spread charts here. So this is. Let's look at the 10-year over the last 6 months. So you can see we were on the rise. We got to a peak in June of 3.48, and that proved to be the bottom of the market. And then as the 10-year rate came off, then the markets went up. We then formed a low around about the start of August. 1st of August was the lows, 2.57, and now you can see we've broken out very, very clearly, and markets have gone into reverse as well. So there's a very, very strong correlation at the moment between this 10-year yield and where the indexes are going. If we look at the VIX over the last 6 months, you can see we had a number of multiple peaks here in May and June, up in the mid-30s, and that looks like where we're headed again. But those peaks, they don't tend to last very long, and they tend to be associated with bottoms in the market. So that's the good news. But the bad news is that in between now and when we get to that bottom, the market is getting more and more nervous. But certainly we're at a level now of sentiment, where sentiment is really at a very bearish extreme, and they doesn't tend to stay there for a long period of time. This is the 10-year, 2-year spread. We've now moved to minus 0.51, and that's certainly saying recessionary conditions are coming. Just while I'm here, this is the crude oil chart, which I'll come back to later, but let's look at crude oil over the last 6 months. And you can see we peaked at just over 120, and that was in June, and it's been pretty much downhill, and we closed just a tick under 80, but I'll come back to crude oil. Sorry, I went to the wrong chart. All right, let's look now at the spread charts, because this is important. This is what's happening on an intraday basis or intermarket basis. So this is the Nasdaq versus the S&P. Very important, because it tells us whether money is rotating more into the aggressive sectors or not. So let's just review what has happened. At the December top up here, bullishness was excessive. The market had run up over the last 2 years. It had run up substantially. Bullishness was very excessive, but the rotation from, even though the market kept rising, the rotation to defensives started in November. It started before the peak. So the smart money was rotating out of aggressives and into defensives. That was where we sat up here. Now, the June low down here, it had flipped around. Bearishness had become excessive, but a rotation back to aggressive had started. Started on the 23rd of May, as you can see there right at the bottom. So you always find, if you follow the money flows, they generally precede tops and bottoms in the index by multiple weeks. So, it's a very valuable signal to follow. We then got a really strong uptrend in all these ratios. But now where we sit at September, they've come off. They've all come off to a degree. But as you'll notice with all of them, they haven't gone back down to their June lows. So, if you're fundamentally bullish like I am, then I take that as a small win. The fact that that these ratios, the market is not rotating defensively to the same degree that it did back up here. So I think that's a little win for the bullish brigade. So we've now got a situation where inflation is persistent. The Fed has really, really firmed up their stance. The market didn't believe what they were saying, but I think now they do. And that's caught the market off guard in the last couple of days. The market had expected that the Fed would back off fairly quickly, but their projections to get to, interest rate of 4.5 on the cash rate, I think has spooked the market. So earnings forecasts are being reset for a recession. And again, this is general market, not all parts of the market. So recession coming, higher rates coming, earnings probably going to be adjusted down, PE ratios down. I also note, again, another sort of bullish thing is that there are still plenty of stocks that are still showing an abundance of intraday accumulation. Now, what that means is that almost all the losses are occurring in an opening gap or in the first hour of trading. And then after that, it generally tends to be the prices tend to go up. And so that means that Wall Street's buying the market. So that's another little positive. But at the moment, those couple of things are being swamped out by the market's reaction to what the Fed had to say. So that's the Nasdaq versus the S&P. This is small cap growth versus small cap value. Not too bad. Really just gone sideways for the last week, despite the smashing that the market got. This is not too bad. This is the large cap Dow Jones large cap growth versus large cap value, and yes, it's peaked and is turning over again, but the last week not too bad. That's not as bad as I expected it to look. Consumer discretionary has come off the boil though, but then again, consumer discretionary had held up extremely well, surprisingly well. And I think from memory, I commented on that last week. But again, we're nowhere near the June lows. The stock indices are, but these ratios between where the money is rotating to and from are not. They're closer to their highs. Semiconductors, this managed to escape sort of in a neutral situation relative to the S&P. So, maybe semiconductors are getting close to their lows, but this is an important one for the bull case, that's for sure. And finally, this is the 1,000 growth versus 1,000 value actually ticked up on Friday night, which is really surprising. And again, you've just got to, that's one hook that you can put on the left-hand side in terms of the bullish side of the equation. So it's not all doom and gloom. Just checking in on currencies. So as I mentioned, the US dollar, massively bullish week, and particularly on Friday night, closed at 113. And if we pan back, you can see just how concerted this uptrend is in the US dollar. So we've got to go back to, this is 2002. So we're now into territory that we were last in May of 2002. So very, very concerted move in the currency because of the interest rates. And if we look at the Australian dollar is really breaking down now. We closed at 64.5, and you can see under really significantly bearish conditions, we could be heading sub 60. 60 would certainly be the next target. So plenty of potential downside yet in the Aussie dollar. Just while I'm here, let's look at the Australian market. So you can see big moves Thursday and particularly Friday. And if you look at the Australian dollar, we are trading at the same level. We're trading at the same level that we were at in 2007. So at the index level, our market hasn't moved for 15 years, which is really quite telling. This is the materials sector. Certainly outperformed on Friday when you look at that candle for materials compared to the index. Very significant outperformance. Iron ore was a bit stronger, which helped, but certainly the big selling in the materials didn't really come through. All right, so just a summary: 64.67. And of course, what that's going to do, it's going to make the RBA's job a lot harder because with the Australian dollar so low, we're importing inflation. We're importing higher prices through the things that we import into the country. So that'll be stoking local inflation as well. So the Australian economy outlook, can't be all that clever at the moment. 2.6, another 2.6 for the week. So a couple of pretty poor weeks, and really nowhere much to hide except in some parts of the market, such as battery materials and the like. And if we look at the emerging companies index, XEC, was down 6.6. That's so small caps really felt the brunt of it last week. Precious metals, gold fell again, ugly, down $30 to $16.45. So we've been, well justified staying clear of precious metals. But because the Australian dollar fell so much, it actually went up in Australian dollar terms. Went up about 15, 20 bucks, up to 25.45. But look, stocks were hit very badly, and I'll just whiz on to those couple of charts. There's the emerging companies index, so pretty nasty there. This is gold on a weekly, so we've clearly broken key support now. That's what I said last week. 1680 support was vital. We finished 1645, so that support's broken. And you're probably looking at the next support now at about 1553 is the next level that I would be looking for. So that's another $90 odd to the downside in gold. Looked out on a daily, you can see Friday gold really fell apart as the US dollar surged. And if we look at GDX or GDXJ, which is I think a more appropriate one to look at these days, some very heavy selling on Friday, and you can see we're starting to head back down to where we were in the COVID crash lows. So the gold stock's not looking too good either. Other commodities, copper dipped a bit, not that much. It was only about 10 cents. Nickel was down about 30-40 cents on last week to 10.50. But it was again quite a good week, particularly for nickel, considering the strength in the US dollar. Crude oil was lower, 79.4 as we saw on the chart. It's really reflecting recessionary fears, and particularly with what's happening in China. So the market is worried about China demand in the near term, but don't lose sight of the bigger picture supply and demand situation here. Long term, the price of crude oil, I believe, has to go higher because the demand is not coming off as quickly as the potential supply is coming off through just the natural the natural fall in production from oil wells, which is just unavoidable and a natural occurrence, and there's not very much investment to replace that depletion. There's the spot copper chart, down just a little bit, and similarly with nickel. All right, wrapping it up. I know this has been a long one, but I think it's been very important to give everyone as accurate a perspective as I can. I'm trading my plan. Times like this, it's really easy to, just to abandon things and make some emotional decisions and dump a whole bunch of stocks. But, I'm just trading my plan, which is really clear, and I'm really comfortable with it. I'm not trading the media. I'm not trading my emotions. I've got very clear signals. I know what causes me to sell a stock, either taking partial profit or full profit or a loss of some description. And I'm just doing that, and I'm just blocking everything else out. Portfolio analyst last week, we covered why fundamental justifications and logic don't always apply in more detail than I've been referring to in this video. And also, really important at this stage is managing risk. And as I said earlier in the video, there are many things that we can control, so just focus on them and forget about the things that we can't control. All right, that's it for this week. I hope that's giving you a valuable perspective. If anyone would like to get some more input, some more perspective, then there's a $1 trial with Portfolio Analyst, which gives you a great insight into how I go about researching both from a fundamental and technical point of view, and also just the strategy and how you manage your finances. So that's it for this week. I'll be back with you next Sunday. Cheers.